Next up here, Lululemon. A lot of people are looking at this like, is this stock not a steal right now, right? Down 67% since the end of 2023, which the Qs are up 41% since then. S&P 500 up 36% since then. And people are like, Lululemon, what is going on here? Almost 70% drop. And I mean, it just shows no signs of bottoming, right? I mean, you look at a day like today, the stock was down like 18%. That's incredible. So in regards to the forward P, here's the issue. If you ever see a trailing 12-month P, the same as a forward P, the same as a 2-year forward P, you should get a little concerned. That could mean the company's profitability is getting in a scary place. Now, you might look at this and you might say, well, they're just supposed to be the same amount of profits. It's not usually how it works, right? Remember, forward Ps are going based upon analysts' projections for the next year, and 2-year forward Ps are the 2-year out, right? So when you see them all 11, you've got to be skeptical because usually companies don't stagnate. As with all things in this life, there's no such thing as stagnation. You're either getting better or getting worse at everything in this life all the time. So when I see 11 trailing 12-month P, 11 forward P, 11 2-year forward P, I say, no, it's not what it's going to end up being here, right? There's literally no such thing in this life as the same. You're always getting better or getting worse. You're either getting in better shape or worse shape, right? Your physical health is either getting better or worse. Your mental health is either getting better or worse. There's no like stagnant. You're either getting better or worse. That's everything in life. Your tree out there in your front yard, it's either getting healthier or it's getting less healthy. Like, it's just, that's life. And so when I look at a Lulu and I see 11, 11, 11, I'm like, I don't think so. No, that's not probable. What's either going to happen here is Lulu's going to turn things around and be much more profitable than analysts expect, or, which is probably more realistic, they're actually going to see their earnings per share go down quite dramatically over the next year or two, and that forward P is not 11, and it's going to end up being way higher than where it's at right now, which is not a good thing, right? So that's something to keep in mind. Additionally, the U.S. growth was basically, there was no growth in the United States. It looked like in the last quarter for Lululemon. That's scary. For a company like Lululemon that's supposed to be a growth company. Remember, Lululemon, we go back to the end of 2023, the stock was $500+. It was priced as a growth stock. So now we have a massive transition that has to happen, and it's an awkward transition. It's a painful transition whenever a company has to go through this, and it's important everybody understands this, okay? What you have happen is a company like Lululemon will go from having a growth investor base to a value investor base. But listen, that takes a while. Now, the value investors don't step in unless they're confident in that company's profitability over the coming years. If the value investors are not confident in that company's ability to generate net income and EPS over the next several years, they will not come in and buy that stock. They will not come in and buy that stock. And that's what you got to remember in regards to this. What is going on with this wind hat, by the way? It's got like a fuzzball thing on it. It's like bothering me. I usually wear my 1000X hats. Where are my 1000X hats at? Okay. So this is an awkward time to go through. If you're Lululemon, you got growth investors saying, peace out, I'm out of this thing. And you got the value investors saying, I don't know if I want to step in this because your profitability is going down so fast. You got to understand, Lululemon's earnings per share was just down on a year-over-year basis. Down. We got earnings per share going down. We have margins going down. Their margins were going down also. And we've got no growth in the United States. Now people are looking at like, Lululemon's about to go negative in the United States. Maybe that happens, maybe that doesn't. I don't know, but that's a true fear. When you start posting a goose egg for growth in the United States, people say, next up, negative. The question is, what are we going to see? Negative 2% growth, 5%, 10% revenue growth? That's scary. So the only growth they're really getting right now is China. Now, additionally, when you look at Lululemon, there's been a big change over the last couple of years in regards to this, and it helped out short-term revenue. And I understand what Lululemon's trying to do here, but here's the issue. So I just went to Lululemon, like the front page, and what am I greeted with? Just a bunch of like random clothes, and this is what they're becoming. And now if you go in their stores, they're selling all types of random clothes, and they're gotten big into men's over the past few years and all those sorts of things, right? And so Lululemon, like how they built this business was on the back of an incredibly successful yoga pant. Everybody knows that. It doesn't matter if you're a guy, a girl, if you've ever done yoga in your life, everybody knows that, okay? That's how they built this into a billion dollar company. But now they're all about these other things, right? They're about trying to sell to men, trying to sell bags. They want everybody to be their customers. So now they've kind of gone wide here, and that's a tough thing. Sometimes it doesn't work. Now they want to sell you a polo. Now what happens is, okay, you want to sell guys polos, cool. All right, now you got to order massive amounts of inventory. What happens if the dudes say, you know what, I don't want my Lululemon polo? If every guy's out there, saying I want a Lululemon polo, that's great. You're going to sell those, at a phenomenal rate, and you're going to make crazy margins on it. But if you don't, you're going to sit on inventory. Then you're going to have to start clearancing. A clearancing's never a good look for any brand. If you want to start having a clearance rack, ugh. Or then you can say you can just take the hit and maybe try to sell it downstream to like a Ross or somebody like that. Not a good look either, right? I mean, imagine, somebody that's your usual customer goes into Ross or wherever and they see your product. It's not a good look for a brand to really be in Ross and those sorts of stores. So this is what's going on for Lululemon now at this point in time, and that's tough because somebody said this recently, like Lululemon's trying to become the Gap. Here's the issue: Lululemon's got a $20 billion plus valuation on it. You know what the Gap has on it? $8 billion valuation. $8 billion valuation. Uh-oh. You want to become the Gap? You can do that. That means still another 50+% downside easily from here in regards to your stock price, right? Now, there's also been a lot of competition that's come in the space. This company named Alo has gotten very, very popular in the space. So, they got Kendall Jenner on the Alo. Interesting. So, yeah, this brand has been popping recently. They got this other brand called Viore, which is, gotten much more popular recently as well. So now they have serious competition. But here's the thing, and this is what I'm always pointing out, because people say, why would you rather buy Nike stock right now instead of Lululemon? Lululemon looks so cheap, right? Here's the issue, ladies and gentlemen, okay? Nike has a brand. Lululemon doesn't have a brand. Nike sells success. Nike doesn't sell clothes. Nike doesn't sell shoes. They sell success. They sell winning. When I went to get 1000X hats made, I said, can I get Nike 1000X hats made? That's pretty cool. Why? Because I want to associate with winning. I don't associate winning with Lululemon. I don't associate winning with Alo or Viore or Hoka or On or any of those other companies. They're just brands. They're here for the hot thing at the moment and then they're gone, right? And I don't want to say gone as in they go bankrupt. They just they kind of go into irrelevancy slowly but surely. And they still have businesses. They still make money, right? Same thing with Reebok and Adidas and all the other brands and One, right? It's all the same thing. It's one company that actually spent countless tens of billions of dollars on their brand over the years, and they built a brand on success and winning and built a brand on something more than clothing, and it's Nike. And they're the only ones to do that. And so when you ask me why I want to buy Nike over Lululemon, it's easy. Because Lululemon, I don't know where that brand is 5 or 10 years from now. It could be completely irrelevant. I know where Nike is. Even more relevant than it is today. There's a big difference there. And so, and what that means for profits long term and all those sorts of things matter significantly. So, just a little something there for you guys, okay? Let's go ahead and let's react to some videos.
In Lulu 3 years ago that others missed.
It was pretty simple. It's the core of the business was running out of gas. And the company, as a result, was trying to expand beyond the core, selling sweaters, sweatshirts with logos on them, Little House on the Prairie skirts that were down to your ankles. That's not Lululemon. So the company we saw was basically trying to stretch for more growth, and it didn't work. So
pun intended.
Pun intended, yes. And now it's running out of gas.
Is it fixable?
It's not fixable because when they were growing very quickly, there was no competition. It was Lululemon was the it company in the it space, especially during COVID, which accelerated the growth of athleisure. What has happened since is there's a ton of competition coming into the market. Alo and Viore are a big problem for this company.
There's an Alo store near me. There's a Viore. I get the catalog.
Is it fixable? I think that's a great question. That's a very direct question. Is it fixable at Lululemon? The answer is not really. Not to a great extent. And the reason being is they just haven't invested in the brand the way they needed to invest in the brand. And they chose to make short-term margins and profits rather than focus on the brand. And listen, Nike could do the same thing. Nike spends billions and billions of dollars a year on sponsoring leagues and athletes and all this stuff. Nike could easily just say, you know what? Screw it. We're not gonna have the best athletes. We're not gonna have our logos all over the jerseys and all this sort of stuff. You know what? We're done with all that. And you know what happened with Nike margins in the short term? Skyrocketing margins in the short term. You know what happens to the brand over the long term? Destroyed, because over time Nike would stop being as viewed as like success, right? And so it just kind of like falters. And that's always the downfall of these companies. I've been explaining this for the last year or two in regards to this as I've been acquiring my Nike shares, right? Because people are like, well, what about this brand? I'm always explaining to them, you understand, decade after decade, brands come and go in the apparel space. And the reason they come and go is consistently because no one understands the way you have to invest in your brand if you want it to be lasting for the next 40, 50 years. And Nike's the only company who has really understood it on that deep of a level, and that's why they remain relevant. I mean, Nike's been in the toughest times they've had in a long, long time over the past year or two. And guess what? Nike's worst times is still better than everybody else's best times. So, it's very important. You got to understand the strength of a brand when you're selling to consumers. It's massive.
The Alo store always appears to be packed.
Yeah.
I don't know who they are. If they're public, I don't think so. What are they doing right that Lululemon?
Yeah, in Alo, I mean, they could be super packed and super relevant right now, and 5 years from now, no one goes there. That's how it is with these brands. They come and they go, and they're just they're the hot thing, and then they're not the hot thing, because no one actually wants to spend the margin and invest in the brand the way you need to invest.
Maybe it's getting wrong. Just no ankle length skirts. I don't know.
I think Alo and Vuori they're sticking to their identity. They have a good casual offering. Their fabrications are great, and their marketing is on point. So what's really scary today is both Alo and Vuori separately have over 100 stores across the United States. That's a problem for Lulu because, again, 5 years ago, these companies, you've never even heard of them. A lot of people haven't even heard of them today, but they're...
Well, we had Athleta, right? Or Athleta.
Yeah, well, that's gets owned by the Gap. That's more irrelevant these days. But
even more irrelevant.
More irrelevant. But the problem with Lulu is actually the key is where it is relevance. It's still a relevant brand, but it's becoming less relevant to the consumer. They're losing their core customer, and that core customer is going to Alo and Vuori.
Well, let's talk about the consumer, because we have the jobs number out today, and it was much weaker than expected. You guys have had, it's a Wizard of Oz theme. Lions, tigers, and bears, oh my, on the consumer. What is that, and how do we read it? And who's going to win? Because somebody's going to win.
Yeah.
Or maybe not.
Great. Thanks for bringing up the Wizard of Oz. It's our negative thesis on the consumer. We talk about lions being negative mall traffic or choppy mall traffic, tigers being rising inventory. So inventories are rising in the retail space for the first time in a number of years, and they're now exceeding sales growth, which is pretty concerning.
Means good for TJ Maxx.
Well, good for TJ Maxx, yes, but not good for most of the mall retailers that are finally bears, which are at peak margins and earnings. So if you really think about this, 2024 was the best year for retail in 20 years. So if you take that and say, hey, wait a second, mall traffic is starting to get choppy and going towards a declining trend line. If inventories are rising faster than sales growth, if comparisons are at peak, their best they've ever done, and finally, oh my, you bring in tariffs. That's going to be a problem for earnings per share.
Retail's a brutal business, man. I had to learn that over the last 17 years I've been in the market. Retail stocks, so hard to invest into. Brutal, man. I've tried to invest in many retailers. A lot of them I made money in, but small amounts of money. I made 10% in the stock or 20% or, it's tough to make money in retail stocks. I'm just going to be honest with you guys, because it's they'll be dead in just dead stocks for years. Then they turn it around. And as soon as they turn it around, something bad happens in the economy or something bad happens with a tariff situation or something like that. Stocks are leveled again. It's just, they're probably the biggest retail stocks are probably some of the biggest money traps in the stock market. Them and oil and gas stocks. Like, if I think about some of the biggest money traps, oil and gas stocks and retail stocks. Because they'll make a ton of money at a particular time, and then, the stocks will start going down before the business turns down, and then after the stock's already gone down, then the business actually starts going down. Because they're kind of like very cyclical, and something happens, and it's just a mess, man. It's just a mess. So anyways, big money sucks.
Hey, it's Jeremy. I hope you really enjoyed watching that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That's my advanced software that I've been working in the background creating for a long time. This software is so much more advanced than what others are presenting out there in the market. And as somebody that's been in the market 15 years, I want to create something that was simple, that had exactly everything I needed to make my judgments on companies, such as forward P ratios, 2-year out forward P ratios, price to sales ratios, forward price to sales ratios. I wanted the ability to be able to compare different companies versus each other. I wanted to be able to compare a Meta versus a Google versus an Apple and be able to see all those different metrics laid out all next to each other. I wanted a service that I could listen to conference calls right through and even be able to toggle and adjust the speed I wanted to listen to those conference calls. I wanted a service that I could search SEC filings right through. I wanted the ability to do that all in one service, and that is exactly what I've created with 1000xstocks.com. If you want to apply for access to this, go to the description area of this video. You can click that link and go ahead and apply for access to this. If you don't want to do that, you can go to 1000xstocks.com. Enjoy.
NKE Nike. So this is one I now own 2,777 shares. Me and Phil Knight, we pretty much control the company at this point in time, okay? And this is just in the public account alone. I've been buying this stock in other portfolios. I'm down 4% on it. I think I'm going to make a lot of money in Nike over the coming years. And I think this is a stock I can hold for years, if not decades, to go in the future. I was watching some football this weekend, like I'm sure a lot of people are watching football, right? Nike commercial came on, got chills from that baby. It's not the first time. I'm just like, man, woo! They know how to, they understand marketing, advertising, branding at a higher level than any other company in history. It's unbelievable what they're able to pull off. I mean, I watch other shoe companies' commercials and it put me to sleep, and then a Nike commercial comes on, you just get chills. It's unbelievable what this company does. No, I spoke about Nike quite a bit on the channel recently, but I recorded a video for my private stock group members, was that a couple days ago or so, right? And I said, what can we learn from Buffett and his biggest stocks? And basically what I did in that video for the private stock group members, I looked over Warren Buffett's biggest positions. And then I said, what can we derive from like Buffett's magic in regards to, how he's been able to grow wealth over time, right? And we came up with basically what I was able to come up with is when it comes down to his biggest positions, he really makes sure they have incredible moats around them. And they're near impossible to really penetrate. And like the companies are almost have like a monopoly type competitive positioning that you just can't end up competing with them. And what you realize when you go down the Nike rabbit hole is Nike has no competition. Now, if you haven't gone down the rabbit hole, that sounds ridiculous. Like, what? Nike has no competition. I mean, there's Adidas, there's Hoka, and there's On, and there's what are the other brands that are hot at the moment, right? I think Lululemon sells shoes right now. I don't know how hot they are. There's so many companies who say, oh, what the heck? How does Nike have no competition? Everybody sells shoes, right? Plenty of companies sell athletic clothes. I can tell you, Nike has no competition. They have no competition. The reason they have no competition is because no one can invest in the brand the way Nike does. What happens is they go through, other brands come out, they go through a hot spell, they decide to reap maximum profits from that, they don't invest in their brand, and they falter. I can take you through the 1980s, the 1990s, the 2000s, the 2010s, and now I can take you through the next generation. It never fails. It never fails. These companies will they're a Nike competitor and they're hot for a few years. They make maximum margin on that. They don't invest in their brand and they falter every time. The closest thing I saw to a real competitor to Nike, the closest thing was Under Armour back in the day. Under Armour was the closest thing. Kevin Plank, he really was investing in his brand at Under Armour quite a bit. And he really spent on it. And that was the closest thing I've ever seen to Nike. And you know what happened to them? They failed. I think Under Armour stock today is like a $5 stock or $7. They're like they've been in a gulag on and off. Like it's just they exist. They're still a company, but it's just like they never became Nike. No one ever becomes Nike. But they were the closest thing. In the last 40 plus years, Under Armour was the closest thing to actually pulling it off. And they still couldn't do it. And so you just got to understand there's no actual competition for Nike. There's only two ways Nike can be hurt, essentially. One is the consumer. When the consumer's in a bad spot, they've been sliced and diced by inflation. That means they have less money to go spend on a new pair of Jordans or, a new pair of shorts or whatever it is, right? A new shirt. So no doubt when the consumer's hurt, Nike can get hurt because Nike sells to everybody. It doesn't matter if you're rich, you're poor, you're middle class, Nike sells to you. The only other thing that can really hurt Nike is themselves. And that's exactly, basically what happened was a guy that was from consulting world, they brought him in to run the company over Elliott Hill. Elliott Hill decided to leave the company. It was a huge mistake. He made a ton of bad moves for Nike. He screwed up. And now Elliott Hill got brought back in last year, and he's running the show again, and he's doing it on a very high level. And he's bringing Nike back to its glory days. And you'll see that continue to play out over the next several years. And so, you got to understand they had basically a double combo. That's why Nike stock is so discounted right now. The consumer got sliced and diced by inflation, and they hurt themselves because that consulting CEO screwed up in so many ways. And but it's all a thing of the past now. Like, it's all a thing of the past, right? The super high inflation, it's a thing of the past now. That consulting CEO, was it named John Donahoe or whatever his name is, joke. Made so many bad decisions, are ridiculous, and that's a thing of the past. And so, you just got to understand that. Now, here's the deal with Nike. If you're not buying it right now during a time like this, you will never own Nike. You'll never own the stock. Because this rarely ever happens that you get the stock trading at multi-year discounts like this. This is the time to be buying a stock like Nike. If you believe in Nike over the next 10, 20 years, you got to buy during a time period like this. If you don't buy now, you will never buy this stock. You got to understand, this company only goes through bad times every so often. So back in 1983, the stock fell 34%. 1984, the stock fell 47%. Massive crash in Nike stock. Imagine if you bought back then, you would be a billionaire probably, or like just ridiculously rich. Okay, let's just call it that. You're rich enough to like have your own yacht. Let's just call it that. Okay. 1986, the stock fell 14.5%. 1993, the stock got absolutely decimated. Lost nearly half of its value that particular year in 1993. 1997, the stock got hammered 34%. In looks like 2002, stock fell 21.5%. 2005, the stock fell 3.6%. 2008, the stock fell over 18%. By the way, this wasn't even to the lows. This is just where the stock started the year versus finished the year. So keep in mind, these numbers were all much worse if you look at intra-year. 16% fall for the stock in 2016. You can take advantage of a time period like this with a stock like Nike, add to that stock, throw it in the filing cabinet, hold it for the next 10, 20 years, or you don't. It's one you either get or you don't get. And I think I get it. And I think we're going to make a whole lot of money in the stock over the next number of years. And then it's going to be such an easy stock for me to hold. As long as whenever Elliott Hill is done with the run he's going to go on, my guess is Elliott Hill will probably run this company for the next 3 to 7 years. Whoever he hands it off to, it just needs to be somebody that's from Nike's culture and understands the company on a high level. They cannot bring in some consulting guy again whenever that time comes. But that's still several years away. My guess is Elliott Hill really wants to make sure this ship is all in the right direction. Revenues, margins, EPS is going up year after year after year before he says peace out once and for all and goes into true retirement. Okay.